Hey, yo.
What's up?
What's going on, man? We back with another one. Listen, we're going to keep them coming. You already know the routine. This is Ced Talk Podcast. You got Ced B, you got AB. We here. We rocking. This is funny. Listen, if you haven't saw the last episode, I mean, people going bananas. We had an episode prior to this one, which is called the 401k is a scam.
Scammer dammer.
And some people didn't like that. You know, that's kind of like talking about someone's personal, like, family member or something,
right.
Or you talking about their spouse or things like that, or their children.
Words.
Those fighting words. If you want to wholeheartedly believe in a 401k, so I just want to really talk about this real quick, and I'm not going to even talk about the 401ks no more. I just want to address something. That my point in the last episode was really for the rules and the regulations that the 401k have, right? So you have a Roth 401k and then you have a traditional 401k. I'm just saying that with the 401k, a traditional 401k, you still have to pay taxes. Is that true? Yes or no? Okay. With the 401k, a traditional 401k, if you access your money before 59 and a half, you'll be penalized 10%. Is that true? Yes or no? Right. But then also with the traditional 401k, let's say for instance, if the market crashes, do you lose money in your 401k? Yes or no? That was the point.
Right.
If you have a 401k, that's on you. Right. Mm-hmm. I have a Roth 401k.
Right. We both do.
And we both have Roth 401ks. And so we're saying that if you're going to fund it to the match, not the max. Fund it to the match, MATCH.
That your company
not
is giving.
Not the max, right. MAX, okay? Because
there's a difference.
A huge difference.
There's a difference. There is a max that you could contribute into your 401k annually. And then there's a match that your employer is matching your contribution to. So that's the difference.
That's the difference. And so if you're doing it to the match that the company is matching your contribution, I'm saying that's the way to go.
Absolutely.
That's it. That's all I'm saying at the end of the day. So when it comes to the taxes, when it comes to the penalties, people say, oh, well, it's supposed to be for retirement. Or what do you think? Why? Of course, everyone don't have the luxury to save or haven't had the luxury to save for emergency fund. Mm-hmm. So it came down to that point where they had to access money that they saved their own themselves in a 401k, and they realized like they were penalized,
right?
Unless it was a loan.
People don't have the luxury to not get unexpected illnesses that put them in the hospital, that incur major medical bills that they can't pay for out of pocket. To where they do unfortunately have to tap into their 401k early. Does it suck? Yes, but what other option do they have aside from that vehicle that they use?
And those who are not educated, that's what we're saying.
Exactly.
Like, everyone is not educated to have an emergency fund.
Right.
And so that's all we're saying. I just wanted to address that really quick because, like I said, if you're wondering and you haven't seen it, go check it out. It's called the 401k. It's a scam.
Yes.
So some people have some words about it. But look, moving on, we're going to talk about another option when you grow your money in. And this is one of the best vehicles that you can grow your money in. It's called a Index Universal Life.
Yes, sir.
Index Universal Life. This is huge because it is a form of a permanent policy, right? A form of a permanent life insurance policy. And this policy has been designed to accumulate wealth. Okay, I'm going to say that again. This policy has been designed to accumulate wealth because of the cash value that grows inside of this policy, and the index strategies that you are using that's connected to this policy.
So some people say that, not some people say, but you have indexes in your 401k as well. How does this perform? How do indexes in the IUL or the Index Universal Life perform against the indexes in the 401k?
Well, it's not necessarily performing against the indexes in the 401k. When you think of an index universal life, it's literally in the name itself, right? It's in the name, index. And so what that means is that an index, because your 401k is inside of the market. So that means you have earnings, right? You have upside potential with your 401k, but you have no downside protection.
Right.
So that still applies, but an index universal life is linked to the market indexes inside of the stock market. So S&P 500, that's an index.
Right.
Dow Jones, that's an index. NASDAQ, that's an index. So you have so many different market indexes in the market that your IUL, right? So we're going to start saying IUL, that stands for Index Universal Life, that your IUL is actually connected to. And so based off the performance of the S&P annually, let's say if the S&P has done 13%, that means that your IUL will be credited that interest, and that's how you build, and that's how your cash value grows.
Okay.
So you earn based off the performance of the market, off the indices of the market. You are credited the interest of those performances, and then your cash value grows.
Gotcha.
And that's huge because anytime you understand the concept of indexing, you really can't lose. And I say that because people say, well, if you can earn the performance of the market, then what happens when the market goes down? Right? What happens when the market lose? Do you lose in your index universal life? The answer is no. Right? The answer is no. And the reason why is because index universal life, they have a floor rate, and then they also have a cap rate. Okay? A floor rate and then a cap rate. So if I was to ask you guys out there, what would you say a floor rate would mean? Right? What is a floor rate? You might be thinking like bottom, minimum,
The floor.
foundation, right? Literally the floor. You're walking on something that's holding you up, but the thing that you're walking on, you can't go below that, right? And so that's when you think of the floor. So the floor, let's say the interest of the floor is 1%, right? So you have a 1% floor. So if your index universal life is linked to the performance of the market, boom, S&P does well. Now your life insurance policy is credited interest. Your cash value grows. It accumulates. But then when the market goes down, guess what? You just didn't earn typically that year.
Right.
You didn't earn what the market has earned, but you still earned your floor rate of 1%. So if your floor rate is 1%, this is saying that you cannot go below your 1%.
Right.
So you have downside protection, and you're still earning interest even in a negative market.
Right.
You're earning interest even in a negative market. Wells Fargo, Chase Bank, right? US Bank, all of these banks, you're earning 0.01%. But in your index universal life, at its worst, you're still earning 1%.
Right.
When we're thinking about our future, right? I sat down with someone and we literally were just talking about different things, different goals, right? Financial goals. And he was like, yeah, I'm well diversified. And I asked the question, I said, okay, well, in what vehicles? Like, let's say if the market crashed, what vehicles will you lose money in? He was like, I never thought about that. But now that I'm thinking about it, I would lose in each of my vehicles that I'm investing in. And I was like, bro, that's not diversification. Like, you want to make sure that you have a vehicle where you can't lose.
Right.
And so that's the thing. It's called an index universal life. Another thing about this is most people say, well, okay, we understand the floor of 1%. Some companies offer 0%. We understand that floor, but you're capped. So you can't really earn the full potential of what the market is actually doing. So why would you do that, right? So people say, why would you have your money in that kind of place where you have caps, right? And so think of it this way. The market does 26%, and you're directly invested in the market, you earn, right? You have gained. Money went up.
Yeah.
But then when the market drops, because that's one thing we do know, like it's not a matter of if, like it's just a matter of when.
Right.
In the market. It's always going to
Very
go up.
predictable.
It's always going to go down.
You know it's going to go up. You know it's going to go down.
And so people say, oh, but every time it goes up, it's always at its highest point. Like you can only go higher and higher in the market, which is true. Like as far as what you can earn.
Yeah.
Like you'll see the pattern of it go down, go up, go way, way, way down, go up and go way up. Like you definitely will see that pattern. And they say when it goes way, way, way up, why not earn the 26% instead of the 13%, right? Or the 14.75%, and get capped? Because when you lose, so yes, people will want the whole 26%, but you literally have no protection.
Yeah.
You have no floor. And so when you think of losing money inside of the market with your stocks, if you lose 50%, it won't take you to gain 50% to get you back to where you were.
That's what people miss.
You would actually have to gain 60 to 70% to get back to where you were.
Yep.
Because yes, it went down, but then it goes up, not up to where you were. It goes up for a little bit and then it goes down, down again. How long did it take you for you to make your money back? But at the time that you're making your money back, because I'm in a vehicle where I have never lost, guess what? I'm always a step ahead of you.
Thank you.
I'm always a step ahead of you, because while you're fighting to make your money back, the next time the market goes up just a little bit, I'm still earning over here.
That part, because we never lost.
We never lost. And then I have a floor rate of 1% where I'm still earning even 1%? In a negative market.
Come on, man. Come on, make it make sense.
So it's huge, right? And so that's the gist of it financially, right? When you're talking about just accumulating cash value, right? And being able to, allow your money to grow in that vehicle. That's how your money grows in the Index Universal Life. But go ahead.
So in my example where I used at the beginning of the video, coming down with a critical, chronic, or terminal illness, whereas in your 401k, you're basically SOL if you didn't save anything in there. But in the Index Universal Life, is there any protection for that?
Absolutely. And that goes into another feature of the Index Universal Life. So when it comes to an Index Universal Life, you have living benefits aside from the cash value benefit that we just discussed. So you have a terminal illness, right? This is where a doctor says, look, you have 6 to 8 months to live. May God be with you.
For real. That's
what they're saying, right? At that point, you actually have full access, 100% access of your accelerated death benefit in your Index Universal Life. They'll give you a lump sum, right? Let's say if you had a critical illness, critical injury, Alzheimer's disease, right? Dementia. Let's say if you have any of these things occur while you're alive but still living, this is saying that once you file that claim, the claim will get approved, and then you're going to get a monthly amount. Let's say $5,000 to $8,000, depending on how much you're funding it, right? You're going to get paid every single month because of that illness that you have for your care. But if you have a job and then the job is paying for it with the job insurance as well, you might have extra money on hand, extra money that you can do whatever you please with. And then they're not going to ask for it back either. If you have a chronic illness, right? And this is huge. A chronic illness, same thing, you'll be able to have access to the money. So chronic, critical, terminal, right? Critical injury. We're talking about strokes, heart attacks, right? Cancer. All of these things happen to you while you're alive. You have access to the money in your policy, your Index universal life.
And then, so another question. With your job, say I had a 401k with the previous company that I worked for. With this new company, or I'm no longer working right now, or I'm with a new company, but they do not have a 401k, or they have a different company that they use. What can I do with that 401k that I had at my previous employer?
Well, I would suggest to roll over the money, roll over the 401k, and place it into a fixed index annuity, not a variable annuity, right? We're talking about a fixed index annuity because the topic, right, of this is index strategies, right? An index lifestyle,
Yeah.
right? The index mindset, like index everything, okay? Because when you roll that money, that old money over from your previous company, what you're doing is, one, you're placing guarantees on that money.
How?
Because of the index strategy. So if you leave your money inside of a 401k and you're not contributing to it, it still can lose based off the market's downside, right? Yes, you can still earn based off the performance of the market. But most people don't want to lose money, especially in retirement. So rolling that money into a fixed index annuity, guess what? They actually have a floor rate that we discussed before, 0% floor rate, and you cannot go below that floor, so you won't lose. And if I were to write this question and say, would you rather have money in a place where you can lose money, or would you rather have money in a place where you'll never lose a penny?
Right.
If you're not upset with me right now, or if you're not in your feelings, you're gonna find every way to not say, "Oh, I'm not gonna roll it over. I don't care. I don't believe in nothing like that. There's nothing like that out there." You're gonna find every reason to come up with to not agree that you would actually rather have money in a place where it won't lose a penny.
Right.
Because typically everybody would choose that.
Yeah.
They'll choose, I'd rather have money in a place where I won't lose a penny. Guess what? We actually have vehicles like that.
Exactly.
And so that's why I would suggest rolling that over. But then here's what most people don't know when it comes to rollovers. Most people, they leave their old job and leave their old 401k. They get a new job and then get a new 401k. And what they do is they roll over the old 401k inside of a new 401k. And they're like, yep, this is going towards my plan and all this kind of stuff, right? Which is cool. You're thinking in the right place. But at the same time, once they realize that they can diversify, most companies don't allow you to do in-service distribution. So like if you're currently working with the company, you can't like, oh, I love that idea. Let me pull the money out that I have now into that. But what you can do is you can actually utilize the money that you rolled over from the previous company. That's called legacy money. Legacy money doesn't apply to the in-service distribution rules, right? So if you rolled over $100,000 from the previous company into another 401k, that's legacy money. You can be like, okay, bet, since I can't touch my own money in my new 401k, I'm going to take this legacy money, boom, and dump that into a fixed index annuity. Let that grow. I won't even contribute to it. Most companies are giving you a 10% bonus. So year one, $10,000.
Sheesh.
Added to your $100,000.
Where else they doing this at?
Where? And then to not lose, like, and there is no cost for you to even make that happen.
Right.
There is no change in your lifestyle to make that happen. Like, oh, I gotta go do this real quick. I need to make this happen before I make this move. Like, nah, like the money is moving. You not. You know what I'm saying? And it's time to let the money work for you instead of you always having to work for the money. So that's how that works. Let it compound, right?
So another question. This all sounds way too good to be true. And if it is, I feel like y'all on some scamish type. Like, how are you getting paid?
So that question for me, you saying
that question? It's a 2-part question.
So explain what because there was some rhetoricals in there. I feel like, but they need to understand what your question is.
My question is a 2-part question. Question number 1 is, this sounds too good to be true.
And so you're saying
The index.
So you're saying this is what most people are
This is what most
saying.
people say, is it sounds too good to be true. How is it that I'm not losing any money participating in indexes? And how is it that I have a 1% floor even when the market is negative? And then how is it that you guys, like, how do we get paid? Yeah. Yes, I'm saying you guys because I'm coming at it, and not from me, but from other people. But yes, how do we get paid?
So first, the way you're not losing money is, like I mentioned before, it's the index strategies. Like if your money is in index strategies, not index funds, where it's still in a market, right? But we're talking about index strategies where your money is not directly invested inside of the market. Your money is directly invested inside of a life insurance policy that mirrors the performance of a market index.
Okay.
And so, and what that means is your money is inside of a vehicle that has different rules from a 401k vehicle. Your money is inside of a vehicle that has different rules from a IRA vehicle. Mm-hmm. Your money is inside of a vehicle that has different rules from a SEP vehicle, right? From a bank, it's different. So the rules of life insurance, right? So you and I both, we have our life and health. Mm-hmm. The rules of life insurance vehicles does not apply to investment vehicles. So that's one. That's why we're not losing, because our money is not, life insurance is not an investment.
Yeah.
Okay. Investments, you can earn, but you can lose.
Exactly.
Investments. Then two, as far as how we get paid, right? So a lot of people, they think that somebody made a comment, oh, you want to screw over on our last video. Oh, this is why you don't give any good advice on 401ks, because you believe in life insurance. Like, you think that term life is inferior to whole life. I said, I never even mentioned whole life.
Yeah,
like, I never brought up a whole life.
Exactly.
Like, what are you talking? And that's why I say I wish it was live, so that way I can have a real conversation with people. But his point was, you probably sell life insurance to get over on people so that you can get paid higher, right? Compensation. So I will say this, us as life insurance agents and financial professionals, we do get paid a lot.
Right.
We get paid a lot of money, right? But the thing is this, if your IUL, your Index Universal Life, is structured properly, the agent is actually taking a loss on how much we could actually get paid.
Exactly.
Okay, so one, we never charge our clients. Our main focus is actually education.
Yes.
That's it. We just want you to be informed. We want to empower you so that you can make the best decision for yourself.
The best educated decision.
At the end of the day. But the providers that we work with over 50 plus A-rated companies. A-rated companies. So that's huge in itself. We're saying that if any of these companies become a B rating, they're not going to even be on our platform. And I'm not even trying to sound crazy, but they're not going to be on our platform, because we want to offer the absolute best to our clients. And so the companies, the providers, they actually pay us. We do not get paid from the clients, right? So if you have a financial advisor and they advise you to put money in a stock market, they advise you to put money in all of these places, and they say, hey, I'm gonna watch it. I'll watch it. You might lose just a little bit, but once we move it, boom, I sell this stock, buy this stock, and doing all these different things, or put your money in this Fidelity, or have this in your index funds and stuff like that. I'm not saying any of these things are bad. I'm gonna be very clear. I'm not saying any of these options are bad.
Right.
I'm saying that because you don't have the knowledge of what to do with money, or how money actually works and how it grows, you're paying someone else to do it for you, which means you will never, ever come to the point of understanding of how money works.
Right.
But then two, if you were empowered on how it works, you know that you wouldn't even have to pay someone
That part.
to do it. And so hopefully that answered the question. The reason why your money is not losing is because it's in an index strategy where you have a floor and you have a cap. Right. And then also your money is not directly invested into the market. It's inside of a cash value life insurance policy. Even the IRS can't get in there.
Right.
Because it's your life insurance policy, right? The rules apply. And then we get paid by the providers of the services that we offer.
Okay. Another question. Thank you for answering that, by the way. What are the cons for the index universal life? You've mentioned so many great things, but what are the cons?
So we have a few cons. There are a few cons with the index universal life, IUL. The first con is that if an agent does not properly structure your index universal life, in the future, your policy collapse because it's not producing enough. You're not funding it enough in a way to where, because if it's not properly structured, what happens is that somebody is going to give you a super high death benefit coverage amount, face amount value. So if somebody give you $1 million IUL policy, and you have no children, you have no spouse, right? That's built for the agent to get paid on that and profit on that, and be like, okay, cool, I got 10,000 off just one sale.
Yeah.
Right. But then at the same time, it's like, that's a con, because yes, you're going to have money growing in there, but you're going to be paying way too much for the cost of insurance in itself.
Yeah.
Way too much. Because if you talk about fees, right, that's the second con. So an improperly structured IUL.
Number one
is an improperly structured IUL.
Okay.
That's one. But two, because of an improperly structured IUL, the fees that you will encounter, like the fees that comes with that policy, will be extremely high because of the coverage, the death benefit amount that you have on that policy is extremely high. So most of your money is paying for the cost of that.
Right.
Okay. And then the third con, and all of this actually ties into to each other. The third con is everyone will not get approved for index universal life. You might hear about it and how it works, and now you feel really excited, like, wow, I need one of these ASAP. But because it's life insurance, you have to go through the whole underwriting process. You have to go through the whole medical process. And you have to be somewhat healthy in order to get an IUL. So this is not just for everyone. So if you're not really taking care of yourself, or due to other things, if you currently have cancer, stage 3, 4, like, you're not getting approved.
Yeah.
If you had a stroke yesterday and then you apply for insurance today, just because you had a stroke and you realize, like, oh snap, I thought that I never needed it, but I didn't think this would happen, and now it happened, and you like, I'm trying to apply, you're going to be declined. Yeah. For sure.
Only about 60% of our clients get approved.
Man, and so that's a con. And so, but then now watch this. That goes into based off of your health rating. So let's say if you get approved, but you got approved with a lower health rating. So higher health rating being that you're in excellent health. A lower health rating is not so much, right? Which means you get approved with a lower health rating. Once again, the cost of insurance goes up. Yep. The cost of insurance is extremely high. And those are really the cons. Like, there's outside of that, there's really nothing that you can really say. Like, the benefits of it is mind blowing. Mm-hmm. And that's why I say, like, the index mindset. Like how is it that in business? Now I'm just talking to the agents, right? Like, how is it that in business that you are offering index products, index services to people, but you got a variable mindset.
Man, that's crazy.
How are you offering index products to people, but you have a variable business? And and you just speaking to ourselves as well. Like we can't go out knowing that we have one of the best vehicles on the planet. And we're not saying that just because we're licensed and we offer this stuff. We're saying that because we truly experienced it. We were clients first and actually saw the buildup and actually saw the cash value.
Right.
Everybody always says time will tell. Some people don't want to wait and see that result of the time.
Yeah.
But how old is our oldest son?
7.
7 years old.
It's going to be 8.
7 years old. He was a baby, right, when we actually started his.
Yep.
Time will tell. And what I mean is that we see the cash value. What I mean is that we see what we have access to. What I mean is that we see the fees decreasing over the years, right, because of how it's structured. That's what I mean. The time will tell. Like, we have 4 children, and when they all were little, we got them an IUL.
Yep.
And then we're saving money into these IULs, and it's just compounding over the years because they're so young. And by the time they go to college, like if they don't get,
illness.
Let's say if they play sports, right, and they get a scholarship.
Yeah.
But if they don't get scholarship, like they're still taken care of.
Yeah.
They choose not to go to college and wanted to start their business, or we can help them with their cars. It's super flexible. And you really can't lose.
And to piggyback off that point too, like over the years is a huge point, because a lot of times people have previously heard of an IUL and they automatically wrote it off because they're like, it sounds scamish, because what they thought it was that as soon as you get this policy that you're going to be growing cash value, like you have cash value to take out. Like we mentioned in a few videos, it doesn't work that way. You have to have your policy in force for years before you can build that accumulation in the policy for you to be able to pull anything out. There's no magic policy here. There's no like, poof, here's this all of a sudden money and now you're wealthy. No, it's you have to put the time in for it to work. It doesn't just automatically happen as soon as it opens.
Yeah. And it just like everyone else says, the 401k is a long-term product. They say you're not supposed to use your 401k like a savings plan.
Exactly.
You use it for retirement. This is really the same thing. Like, this is really the long game, for real. Long-term game. You open up IUL, but you're utilizing it too, like, because of the benefit. If you had that emergency. So, like, if I'm comparing the two products, if I'm comparing the two services from a 401k and an IUL, like, if I had that emergency, right, everybody was bashing me like, oh, you can't do this and do that. That's a savings plan. I mean, that's for retirement. That's not a savings. And I was like, I get it, but, like, emergency is an emergency.
Right.
At the time, I didn't have that. And this is, 8 years ago? Like, you guys are talking like I did that yesterday.
Right.
You clowns. I'm speaking literally from experience. Like, this didn't happen yesterday.
Right.
But because of that experience, I learned to be better with money.
Absolutely.
And also because of that experience, I'm like, why would I invest so much here if I have a vehicle where I can't lose? And so the difference is, if I had an emergency with both vehicles, I could easily access the money that's in my IUL versus my 401k. My 401k, they're like, oh, you gotta file for hardship.
Right.
You got to do this and do that. My IUL, I can borrow money. And here's the cool part about the IUL. My IUL, I can borrow the money in the form of a loan or withdrawal, but definitely go the loan route. Loans tax-free, but you might be thinking, whoa, you have to pay it back. And then also the interest. People be like, well, the interest that you're taking out on these loans will compound as well, that you're getting charged with. Not necessarily. Then this is why. Because if I borrow $20,000 from my IUL, and if I try to borrow $20,000 from my 401k, guess what? I can't. If I'm still employed at work, I can't take that much out of my 401k. They're going to say, you only can do $2,000. Because of where you at, you only can do $2,000. And it's a loan, so you're borrowing it. And then I have to pay it back. So when I get the money in my 401k, I already have a payment plan. They sent me a whole payment plan of when to pay it back. I said, dang, I can't even think about it. But when I borrow $20,000 from my IUL, the company, the provider, loans it to my bank account. They will put the money into my bank, the $20,000, and then guess what? They're like, yo, this is a lot of money, right? We need some kind of collateral. So what the companies do, they actually place a lien. They place a lien on your life insurance policy saying that if while they are alive, they do not pay back this $20,000, we'll just deduct it from their death benefit when they pass away. So they go all their life without paying it back, and they're not asking for it back either. And then that person passes away. Before the money goes to their beneficiaries, they'll deduct what they've borrowed from the death benefit. And then from that, the rest goes to their beneficiary. And that's huge, because if they loaned me the money and it has not come out of my life insurance, that means the $20,000 that I borrowed from the company is actually still growing uninterruptedly in my life insurance policy, as if I never took it out.
Exactly.
So it's still compounding over the years. In the company, they're just collecting it on the interest. They're like, interest alone have paid back your loan.
Right.
And so don't worry about it, and I'll just take it when you pass away.
Yeah.
It's one of the best vehicles. You can't compare any of the benefits to two vehicles. You honestly can't do it. I'm trying to think one vehicle as far as the benefits, though. And don't be in your feelings. Like, when you start comparing, just really be open-minded. Like, I'm not here to argue. Once, this is my show. You feel me? So, like, I'm not here to, like, I'm not bashing on y'all. Like, y'all tuned in and y'all heard it. Right. So get out your feelings. So what I'm saying is just really be open-minded and just compare. And just for you guys' record in the notes, this still might seem too good to be true. But everyone knows about the IRS. This is the last thing I'm going to say. We're going to close this. Everyone knows about the IRS.
Yeah.
Everyone. Oh, yeah, I know about that. They keep taking money out of my... Right? You know about it. Guess what? These are IRS-approved tax codes. 7702. Write this down. Because don't be mad at me. Don't blame me. 7702. Write that down. Look it up. 72 in the letter E. 101 in the letter A. Those are tax codes. These are IRS-approved tax codes. Come on.
Now, after you write them down, put it into work, Google them, and pull it up for yourself and see what it says.
Pull it up for yourself. And then once you are amazed of what it says, you contact us.
Yeah.
And we're going to take care of you.
Absolutely.
Because it's not for... What we do is honestly not for us. We want to provide a properly structured IUL and teach you how to properly fund it.
Yeah.
It has nothing to do with us getting paid because, one, you're not paying us.
Exactly.
So one, why does it matter? It should matter. Always be cautious of who's trying to get over on you. It should matter. I want to be clear. But I'm saying, like, why would it matter if I'm talking to you one-on-one if I'm not even charging you? But education is key, so it does matter. But what we're saying is that our goal is to make sure that you have the best IUL for yourself, the best results for yourself, right? The best accumulation for yourself. Boom, without getting worked over with a high death benefit amount.
Absolutely. And we're never scared to like show what we're going to earn to our clients because you never know who's also interested in doing what we do as well.
Yeah, most definitely, man. So it's good, man. It's another episode on Ced Talk Podcast. But listen, it's a financial game changer. It's a series. We keeping it going. We keeping it rocking, man. We are out, baby.
Bye. Gone.